just an aspect of convention. There are lots of things. Let me go back up to here. This is how we quote. Is the dark blue line to avoid these zigzags. And so when you see, if you're sitting there, let's say it was back in March of 2019, this specific bond, I would see on my screen or on my quote from my broker, around 103.75, or more likely at 103-28. Or no, not 28, 24. 103-24 for 24 ticks. I would have to know that for this specific bond, I'll have to pay that 124. Annotate. I'll have to pay that one, 103-24, but on top of that, I have to pay the extra amount to get up to this, the accrued interest, the difference between the light blue line and the dark blue line. And so that's why it can be a big deal. All right, we did this problem last week. I think there's a mistake on this slide here. That's more accurate. I think I made a mistake on this. I'll have to post that. Again, what did I just do? There we go. I think that's not correct. I think I had a typo in there. Yeah. I had the 2 in the wrong spot. No, I didn't. Yeah, I feel a bit better now. I had it right the first time, so it wasn't a typo. It just looks a little better with this formatting. So 2.25 years to maturity. Now, this pricing formula is going to be more realistic. And I've said it before, and I'll say it again, even though it's more realistic because bonds typically in the US are semi-annual pay, me trying to test you or quiz you on semi-annual pay bonds is more me trying to essentially test your ability to either use a financial calculator or really understand accounting and accruals for converting between 6-month periods and 12-month periods. Conceptually, I think that really what you really need to know is the concept of things like discounting. We have, in most organizations, they're going to have tools for you, if you're pricing bonds or doing anything like that, to actually have that worked in. You don't have to actually do the calculations. You'll have to understand them and understand conceptually what they're doing, but this is more of an exercise in Okay, can you actually do it out? I'll do it completely. I will do this problem if there is anyone on the, in the session right now that wants me to do it. Otherwise, I'm going to move on. So if anyone has a strong desire to see a semi-annual pay bond priced out with accrued interest, let me know. I'll pause. You can use the raise hand button. You can talk in the chat. You can ask me verbally by unmuting your line, whatever you like. Okay. I'm going to move on then. If you do want me to work through this in office hours, I'm happy to do it there as well. The world of banking and finance are, financial markets, not really known to be PC. And you can see that in many different aspects of banking and financial markets. One area is here. They have names for bonds that are less than sensitive. So Yankee bonds, bonds that are sold in the United States in US dollars that are issued by companies outside the US. Eurobonds is a broader term. Those are actually, I believe, dollar-denominated bonds that are sold outside of the US financial markets, if I remember correctly, and it should state that in the book as well. Samurai bonds, yen-denominated bonds sold in Japan, issued by non-Japanese companies. Bulldog bonds, which are listed in the book as well. Pound sterling denominated bonds sold in the United Kingdom by non-UK companies. There are probably several other terms, and it's just a matter of they were coined many, many years ago in a much different environment. And because that's what the industry has used for years, there's not been a large enough catalyst to change these terms. They have, for now, persisted. Maybe that will change. I don't know. But these are more colloquial terms that, if you hear them, they're just kind of describing things like where the issuer is actually headquartered versus where the bonds are issued and what currency denominations the bonds are issued in. All right, we're going to start talking here about probably the more difficult aspect of bonds that has to do with coupons, interest rates, and things like duration. And I started here in this segment. I'm going to continue with it within the second half of the class. I'll probably end early because I think we're actually running a little bit ahead. So rather than me try and force more material in the session today, I'd actually like to go through some problems from the textbook. All right, so, This is the formula for an annual pay bond on the screen. Market yields are essentially a representation of interest rates. We've talked about credit spreads. So if you think about it, if it's a risky bond, it's a corporate bond, embedded in that yield is the risk-free interest rate and some form of credit spread, some form of premium interest spread to compensate the investor for the fact that they are bearing repayment risk, they're bearing default risk, credit risk. What happens if the yield increases for whatever reason? It could be the risk-free rate increases, the term premium increases, or the credit spread increases. Those are the three main parts of the bond yield. Well, so the yield increases. The denominator is going up. That means that the whole value should go down. And that's something that you may have heard before in other classes or heard, watching certain financial market news stations or reading about them, reading about bonds in books. Yields go up, prices go down. It just has to do with the fact that what the yield is actually telling you, it has an inverse relationship with the price. How much is the price going to change? That's the next big question. How much will the price change? And so Frederick Macaulay came up with a measure to assess price risk. And the risk of, how much does the price change when interest rates or yields change? And he called it duration. Duration is the weighted average time to maturity, or in other words, to repayment. But there are peculiar weights on there. Here's the equation for duration. So let's see if I can annotate. Right there's the weight. The K represents the time to payment. How long do I have to wait? How long will it be? I have to be careful not to use homophones. How long will it be before I get that payment? And the weight is the discounted cash flow itself. In the denominator is just the sum of the weights. The sum of those weights is simply the price. Macaulay duration is represented in years. And if you just see duration, and if you do go farther into studying bonds, if you see duration, you just pretty much assume that it's Macaulay duration. Usually there's another form of duration that's called modified duration, but most of the times when it's modified duration, they say modified duration. The higher the duration, the higher the interest rate risk, the larger the bond price will swing for the same amount of change in yield. For a zero coupon bond, I'll try and say this multiple times over the course of not just this class, but all classes where we talk about duration and interest rate risk exposure. For a zero coupon bond, those coupons are zero. So the only thing that's left is that last payment. For a zero coupon bond, Macaulay duration, or simply duration, is equal to the maturity of the bond. Any other type of fixed income instrument is not going to be the same. It's going to be less than the maturity. But for a zero coupon bond, Macaulay's duration will equal the actual time to maturity, because those coupons are zero. The weight is zero. You do not need to memorize this equation. And again, those of you who are unfamiliar or uncomfortable with summation notations, we will work example problems so you actually see how it works in reality. you do need to understand what this means. So you do have to remember, or you can't commit it to actual conceptual understanding. You do have to remember just rote memorization. So this is a really important part about bond investing: duration, and once we get to it, convexity. This is going to be directly related to the percent change in the bond's price for any given change in yield. It's not exactly that, but it's very comparable. Whenever you're comparing bonds that are otherwise the same, if one is a zero coupon bond and the other one is a non-zero coupon, so a positive coupon bond, same maturity, similar yields, the zero coupon bond will always be more interest rate risk sensitive. Will always have the higher duration. Everything else the same other than the coupons. Certain things that change duration when you're comparing bonds, if it's a higher time to maturity, that increases the duration. Obviously, it has a longer time horizon on it, so the duration will be longer, will be larger. Coupon rates. Lower coupon rates makes for a higher duration. So there's a negative relationship. There's an inverse relationship there. Now keep in mind that duration is directly related to, I should put, is directly related to percent change in bond relative to change in yield. But that would suggest that it's fairly constant, that it doesn't change. If you actually look at the price of bonds and you turn it into a percent change, and these are actually, I calculated these by actually using the bond formula in Excel, so I know that these are pretty accurate. They all started around, I think, 3.5%, what it looks like. Yield, what happens when the yield changes, when it goes down a full percentage point? If the yield is going down, price is going up. But what's the percent change in the price? And these are, I believe, roughly, I think they're 10-year bonds. 10-year for maturity bonds. I say that because if I look at the zero coupon bond, yield goes down 1%, 1 percentage point, bond price increases by about 10%. But it's not a straight line. These are curves. And that's the problem. When we're using duration, duration is telling us, giving us a measure of the slope, the steepness of the slope, I should say, because the slope is negative. Duration is always positive. But it's giving us a measure of the steepness of the slope of this curve, but only at a specific point. But the function for a bond is a convex function. It's curved. The name for it in mathematics is a hyperbola. A hyperbola when you're doing price as a function of yield. And so when we're estimating using only duration, and this is modified duration that tells us the exact slope at that point, we're moving along that gray line, which is the estimate, duration estimated price. So it doesn't matter which direction we go. As soon as we get, there's always going to be a little bit of difference, but once we get meaningfully away from the current yield, we're always underestimating the price, always. And we'll talk about this more in the next set of slides. But are there any questions about duration? Modified duration, don't worry about it yet. That is in the next topic, which we'll probably talk about a little bit today. Any questions, concerns? Those of you that have an interest in doing more with bonds, and you have let's see, go back to my bond price formula, and you enjoy doing calculus problems, take the derivative of this equation with respect to yield. And you'll see how Frederick Macaulay came up with his measure for duration. All right, default risk. So default risk in bonds and credit in general can be mitigated. Now, the way that they work for loans, there are typically more what are called covenants and restrictions in loans, or they can do things like they can have, negative restrictions or positive restrictions. So they have negative covenants, positive covenants. So it's much easier for a bank to write in these restrictions because they're typically going to be much more closely monitoring what's going on with the company. They're going to have a relationship manager that actually goes and visits. And the relationship manager might notice, oh, gee, doesn't look like they're operating at full capacity. That means that they're probably not selling as much. That actually is a risk to us, and they can actually come up with ways to mitigate the risk further. But usually they actually put in the contract, in the loan specifics, different measures, different financial measures. And for instance, and they go through this in the book too, but things like making sure they have a proper interest coverage ratio. So EBIT, one measure, typically that's EBITDA divided by interest payments, annual interest payments. They got to have other measures, profitability measures. You have to meet these profitability metrics or these cash flow metrics, where it's usually stated as a ratio or as a percent of revenue or something that makes it easier to measure. And if there is a covenant breach, the bank will typically have some way of curing the loan, some mitigating factor, so they can do things like limit any further draws on a line of credit. They can increase the interest rate. It's all written into the loan documents. Bonds don't have quite that amount of flexibility. They're securities. The bondholders might not be have a representative close enough to the actual borrower. And on top of that, they might not have, access to actually go and visit the borrower's site. They still can have embedded in them some form of covenants, but they're usually not as stringent. The most common one is called a negative pledge, where they essentially say that you cannot pledge above a certain percent of your assets for other credit extensions. And one company that actually, I think that it was resolved, but bondholders for Transocean last year sued them and took them to court and tried to force a default because they said that Transocean had actually violated their negative pledge on the bonds that these bondholders owned. So what that means is that Transocean had assets that were, not, unencumbered is what it's called. They have to have a certain percentage of unencumbered assets at a minimum. It's usually something like 80%. But they said that with Transocean, they issued bonds that were collateralized with some of their assets, that violated the negative pledge because they went beyond that threshold. It did not force a default. They did end up getting cured. I don't know the specifics of how it did, whether the judge found in favor of Transocean or not. It's probably in the public record. But that's typically the most common form. Another one would be subordination covenants. You can't subordinate, there's some bonds that will not allow subordination of the bond, so no one can be held below whatever subordination level. That those bonds need to be kept at that subordination level. Loans can get packaged into their own form of debt securities. They are called collateralized loan obligations. And the CLO market from 2014 to 2019, and this actually became a problem in the spring of last year, had a lot of not just covenant light, but no covenant loans. So a lot of CLOs that were being issued, loans that had zero covenants, zero mitigating documents or mitigating rules of operations for the lenders. They were packaged into large pools, and then those pools were then essentially sold as the cash flows were sold to investors. It's essentially like securitizing a whole bunch of loans, which are usually small to mid cap companies or private companies, into a big pool and then selling securities off that are backed by that pool of loans. Now, things that securities and debt investors can do to limit their credit exposures, they can do different approaches. They can transact in options markets for equities. That can be expensive. Another thing they can do is transact in what's called the credit default swap market. Now, CDS markets got a little bit of a bad name in the financial crisis of 2008, 9, and 10, or 2007 through 2009, rather. The actual market itself, by that point, was already operating okay. It was actually, in my opinion, it was the securities that the CDS were essentially insuring. They were insuring garbage. And that's where the big problem came about. There are lots of problems that happen with the CDS markets. You can have more CDS contracts that trade than there are actual bonds to cover them. And that actually created a big problem when one company defaulted and there were like 8 or 9 times the amount of CDS out in the marketplace than there were actual bonds that traded in the marketplace. That caused a problem because then it bid up the bond prices, which were maybe worth about 13 cents on the dollar. It bid them all the way up to par value. So significant problems that caused, that sparked, we need to kind of reform how these operate. CDS are expensive. It is essentially an insurance contract. It's an insurance contract between two parties in the financial markets. The party buying the insurance pays a fee. It's like an insurance premium. That fee is tied to what's called the CDS spread. CDS spreads are typically quoted in basis points. 1 basis point is 1/100%. The insurance provider gets to keep the spread as revenue, kind of like a bond, like an interest payment on a bond. But if the underlying bond, or if it's a CDS for a loan, the underlying loan defaults, then the insurer, the protection provider, essentially has to buy the bond at full par value. This is called physical delivery. I provided an insurance coverage to someone else. The company that, the reference company, the reference entity defaults. I essentially pay full value, full par value for the bonds. My counterparty delivers the bonds to me. Now I have to line up with all the other debt holders and stakeholders to try and get as much value as I can back from these bonds. Now, I already mentioned the problem that arose. I think it was it's called Delphi. Was the company, but they've actually changed them so that they can. There's an auction process, and the protection buyer has the option to do physical settlement or cash settlement. What's the cash value of the losses that would make me whole as a bond investor? I'll just take the cash instead. So it actually makes the market operate a little bit more smoothly without causing distortions in the bond markets like it has in the past. I can talk for a long time about CDS. That's actually one of my first jobs working in the financial services industry. All right, so the nomenclature for CDS, and I do this not, I don't typically again, test on this, but if you do go and work somewhere and people are talking about CDS and it's people who actually work in the CDS markets, the nomenclature is different. The short party is the protection buyer. And that's confusing. But think about it in terms of their exposure to the actual credit. They are short credit if in their CDS markets. That means if the credit just completely turns south and the company just becomes extremely risky, this CDS party will get a gain. They'll earn money on their value of their CDS contract. They're only paying 75 basis points when the marketplace now, since the risk has gone up, it's 375 basis points. They can just sell that contract to someone else and make a pretty big gain. You'll also hear people talk about it as short notional, because it's like a giant option contract, or more accurately, a series of options contracts, where they have the option to sell the bonds to another party. So typically think about it from those ways. Short notional, short credit. That's the same thing as the protection buyer. And so you just flip everything around. The long CDS party, long credit, long notional, they are the protection provider or protection seller. Now, again, there are lots of things that I talk about in classes that seem like I'm trying to confuse you on purpose. I'm not. I'm trying to make you aware of how these markets actually work, how the people that work in these markets talk. If you do end up going and working in any of these areas, hopefully that gives you a little bit of an advantage. Any questions? Okay. Let's see. Let's do a couple questions from the textbook, the ones that I wanted to go through, and I'm happy to go through others. But chapter 10, or actually, no, I'll start with ones I've written down. So chapter 2, number 3. And I'm going to ask for participation. So let me see. I haven't done annotation on. Are you able to annotate? Is anyone able to annotate? Do I have to allow it? There we go. Okay. All right. Use the little stamp and use a check. So I'm going to. And then you'll have to delete it on your own. All right, clear all the annotations if you can. Let me see if I can do it from my end. Okay. All right. So A, and you can use if you use the stamp button and use a check. I think that hopefully it makes it anonymous. But I guess, well, it doesn't for me. I can see who it is, but I don't know if you can. So if you're worried about not being anonymous, the point of it is that you are anonymous. So let's see. All right, A, what would be the likely effect on a bond's yield to maturity of an increase in the issuing firm's times interest earned ratio? Times interest earned ratio. Let me pull back the chapter to make sure that I'm giving you the correct. And if anyone remembers off the top of their head exactly what that means from the textbook's perspective, that's fine. So times interest earned ratio, that would be, is that a higher? I'm trying to find in the textbook so I don't give you something incorrect. They don't have it in this chapter. All right, let's how many times you have earned your interest. So higher means you have more income per interest. So you are more profitable based on your interest. Lower means you have less income per interest. So it's probably cash flows. So if you have a higher, let's say, EBITDA over interest expense, is that going to increase or decrease the bond yield to maturity? Of higher EBITDA, I'm going to put this in my terms, so EBITDA I call it interest coverage. If I have higher EBITDA divided by interest, that goes up. Is that going to increase or decrease a bond yield? Two answers, and there we go. Okay, of the people that answer, I would agree decrease. Decreases the risk. If I'm earning more cash flows for the same amount of interest, that means I'm a less risky company. Okay. All right, now B, an increase in the issuing firm's debt over equity ratio. If the debt to equity ratio goes up, is that going to increase or decrease? Yes, increase. A firm becomes more leveraged, they are riskier. Okay. C, an increase in the issuing firm's quick ratio. So the quick ratio, let's see, that is that current assets over current liabilities? Yeah. Decreases, in theory. Yeah. It's a sign that their balance sheet is a little bit healthier. Okay. All right. So are there any other questions? I didn't see many more from chapter 2 that I really wanted to go through necessarily during class today. If anyone wants me to, I will. So you're more than welcome to ask me. Well, that's not chapter 2, that's chapter 10. Going through this too fast. That's why I couldn't find their definition of times interest earned ratio. All right. I was going to do see. I think number 20. Number 20, chapter 10. No, not number 20, 10. A lot of these are problems that we've already kind of gone through. Might have been a concept check that I wanted to do. So a comment about yield to maturity. I typically do not test on yield to maturity because that I feel is more you understanding how to work your calculator than anything else. So when you, Steve, to answer your question, if you go to the drop-down menu, there should be a little annotate, or actually, I guess it's at the bottom of your screen, isn't it? There should be an annotate button. You click on that. There's a stamp, and if you click on the stamp, you can use an arrow, you can use a check, there's an X, there's a star, there's a heart, in case you really love bonds. There's a question mark, which is probably more appropriate, which means bonds are confusing. So. All right. Number 7, I'll read it out in chapter 10. 2 bonds have identical times to maturity and coupon rates. One is callable at 105. The other is callable at 110. Which should have the higher yield to maturity, and why? This one is a little bit confusing. I would probably, if I were wording this, I would call it yield to worst. Has anyone come across the phrase yield to worst before? This is something that's used for bonds with an embedded option. Essentially, you work through, okay, what's the yield that you would expect at repayment? What's the yield if the embedded option is exercised? Which one is the lower yield? It's the worst case scenario of the embedded options for the investor. So which one should have the higher yield to worst? I would say the 110. So the market is going to say essentially, well, these are 10-year, let's say they say 10-year bonds, or just say it says identical times to maturity and coupon rates. The callable at 105, you get a picture of a they have what's called a negative convexity to them right here. Oh. So the yield to worst, the call option is owned by the issuer. So callable bonds it is like a call option for equities, except it's the company that gets to buy them. So the company has the call option value. And so callable 105 means that if the bond's price goes up, once it gets close to 105, it stops going up. Because the company can buy it. So the market will start to essentially shift away from those in favor of the 110s. If they're two very similar bonds, very similar issuers, similar industries, they'll probably shift away from the 105s and gravitate towards the 110s because there's more upside with the 110s. This dotted line here that you see on my screen and this analyst notes for CFA study, that's called negative convexity because the curvature shifts. The company gets to buy these bonds back and issue new bonds at lower interest rates. So the investor is worse off. Now it's confusing because when a company decides to issue a callable bond, when they decide to issue them, they have to incentivize the investors. And so when they issue a callable bond versus a vanilla bullet bond, the callable bond will have a higher yield at issuance. Otherwise, no one would buy the callable bond. The company has to compensate the bond investors for the fact that they have an embedded option that they can exercise. And the way that they compensate them is by having a higher coupon rate and a higher yield at issuance. Are there any questions about callable bonds? That concept is important. How often do companies actually call them? Whenever it's in favor. So I don't know a percent that I could give you, but I do know that bonds have been called a lot. Ones that have had embedded call features in them over the last 2 years, they've been called a lot. I don't keep a running tally of them. Bond markets are actually very difficult to get a lot of information like that from because it's so disjointed. And you essentially have to go and look at investment bank companies' research teams. But I do know that a lot of bonds over the last couple of years have been called because interest rates have been so low. I mean, the 30-year T-bond went below. Goodness, did it actually hit below 1% at one point for a couple of days? And it's just been extremely peculiar time. That's callable bonds. Any other questions about callable bond securities? Puttable bonds. And I'm going to add this in here. Bonds that have an embedded put feature. And you can use your, I always forget to turn this off. Higher yield. Then okay. Do they have higher yields or lower yields than vanilla bullet bonds? I see a check mark low on my screen. I don't know what that was an accident or if it was. So one brave answer. Anyone agree or disagree? So the bond investor owns the option. They would sell it back if interest rates went up. The bond issuer would have to repay and issue new bonds at a higher interest rate. It is an option that is owned by the investor. The investor has to pay the issuer for that option. And the way that that works out is that they say, well, I will lend to you at a lower interest rate. This is more favorable for me, the bond investor, so I will take a lower interest rate, a lower yield on my bonds than a vanilla bullet bond that is not callable, or sorry, that is not puttable. This is where things like the sinking fund provision come into play, where companies will say, well, to give some assurance that we will be able to pay these bonds back, we will have a sinking fund provision. We set aside money that will pay, that will essentially be in a fund specifically to repay these bonds if they end up being put to us. I'm going to erase annotations. Are the annotations anonymous from your point of view? No, okay. Kind of defeats the purpose of annotations. So I prefer it when they are anonymous. Maybe that's a setting I need to play with. I'll see if I can find out. Okay, we're at 7 o'clock, quite a bit. And let's take a 10-minute break. We'll come back and I will talk a little bit about duration and convexity a little bit more. And then we'll close for the evening.